Imagine if there was a rule that capped the price of gasoline. No matter what happened in the world, no matter how much demand surged or supply dropped, you'd always know the maximum you could be charged at the pump. It would be a safety net for your wallet, protecting you from sudden spikes and unpredictable costs. That's what a credit card interest rate cap would do: set a legal limit on how much interest companies can charge you. It's a way to shield consumers from the shock of sky-high rates, especially when times get tough or when unexpected expenses force people to rely on credit. Right now, rates can soar above 20 or even 30%. For many families, that means a small balance can quickly snowball into overwhelming debt, making it nearly impossible to catch up. The interest alone can sometimes be more than the original purchase, trapping people in a cycle that's hard to escape. A cap, say at 10%, would force companies to lower these charges, sparking a fierce national debate. Supporters say it would level the playing field, making borrowing fairer and more predictable for everyone, not just those with perfect credit. On one side, politicians and consumer advocates argue high rates trap people in debt, and a cap would offer real relief, putting more money in families' pockets. They believe it could help millions avoid bankruptcy, reduce stress, and allow people to save for the future instead of just paying off interest. On the other, banks warn that capping rates would force them to stop lending to riskier customers, cutting off millions from credit they rely on. They argue that without the ability to charge higher rates to offset risk, they'd have to tighten lending standards, making it harder for people with lower credit scores to get approved. This isn't just about numbers. It's a fundamental question. Should the government step in to protect consumers from high costs, even if it means some people might lose access to credit altogether? Or is it better to let the market decide, accepting that some will pay much more for the same service? The debate touches every corner of the economy, from Wall Street to Main Street. It affects how banks operate, how businesses set prices, and how families plan for emergencies or big purchases. Should we prioritize access to credit or affordability of credit? The answer will shape how you borrow and manage money for years to come, influencing not just your monthly bills, but your financial security and opportunities for the future. Leading the charge for sweeping financial reform is President Donald Trump, who has made headlines with his latest proposal targeting credit card interest rates. At the World Economic Forum in Davos, Trump took the global stage to demand that Congress cap all credit card interest rates at 10% for 1 year. This bold and controversial move is designed to provide immediate relief for millions of American families struggling under the weight of mounting credit card debt. By calling for such a dramatic cap, Trump is signaling that he's willing to take on powerful financial institutions in order to help everyday people. The idea didn't come out of nowhere. Trump first floated the concept on social media, using his platform to urge credit card companies to voluntarily lower their rates. He framed it as a patriotic duty, appealing directly to both the companies and the American public. But when the companies failed to act, Trump quickly shifted gears. He called for Congress to step in and pass legislation, timing his push just before the high-stakes congressional elections. This move put pressure on lawmakers and made the issue a central talking point in the political arena. By zeroing in on credit card debt, Trump is tapping into a deep well of voter anxiety. Across the country, families are feeling squeezed by rising prices and stagnant wages, and credit card bills are piling up faster than ever. For many, the idea of a 10% cap offers hope for real, tangible relief. Trump argues that surging credit card debt and sky-high interest rates are holding Americans back from achieving financial security, while credit card companies continue to post record profits. He claims their profit margins now exceed 50%, painting a picture of an industry that's thriving at the expense of ordinary people. This narrative has struck a chord with many who feel left behind by the current economic system. Framing the issue as one of basic fairness, Trump insists that credit card companies can afford to lower their rates and still remain highly profitable. He points to their massive revenues and argues that it's time for these corporations to give back to the consumers who fuel their success. The proposed 10% cap is pitched as a necessary step to rebalance the scales and force the industry to share its prosperity with the public. Supporters say it could help millions of Americans get back on their feet, while critics warn of unintended consequences. Either way, Trump's push for a cap has reignited a national debate about fairness, corporate responsibility, and the future of consumer finance in America. President Trump's core argument is straightforward. By putting a cap on credit card interest rates, more money stays in the hands of everyday Americans instead of going to big banks. The idea is that when people pay less in interest, they have more to spend on things that matter, like groceries, rent, and saving for the future. This isn't just about numbers on a statement. It's about real-life relief for millions of families who feel squeezed by high interest rates every month. For example, if you have $1,000 in credit card debt at a 22% interest rate, you end up paying $220 a year just in interest charges. That's money that could otherwise go toward your children's school supplies, medical bills, or even a much-needed car repair. But if the rate is capped at 10%, you'd pay only $100 in interest, a savings of $120 for every $1,000 you owe. Over time, that difference adds up, especially for families carrying balances month after month. For families living paycheck to paycheck, that's not just pocket change. It's money that can help cover essentials like food, utilities, and transportation. It can mean the difference between falling behind and getting ahead. Supporters of the cap argue that this policy would act as a form of economic stimulus. With lower interest payments, people can pay off their debts faster, freeing up cash to spend at local businesses and support their communities. This extra spending power can help small businesses thrive and keep local economies strong. More of each payment would go toward reducing the principal balance, not just paying off interest. This gives people a real chance to break free from the cycle of debt and start building a more secure financial future. The cap, Trump argues, would also send a powerful message. There are limits to how much profit can be made from lending to vulnerable consumers. It's a way to hold financial institutions accountable and ensure they don't take advantage of people who are already struggling. Ultimately, it's about creating a fairer marketplace, one where ordinary Americans have a fighting chance to get ahead, break the cycle of debt, and build a better life for themselves and their families. JP Morgan Chase CEO Jamie Dimon calls the 10% cap an economic disaster. Speaking in Davos, he warned it would destroy the business model that lets banks lend to a wide range of customers. Interest rates, he argues, reflect risk. A flat cap would make lending to anyone but the most creditworthy impossible. Dimon predicts banks would cut off credit to 80% of Americans. Young people, small business owners, and families using credit cards as a safety net would be left out. He challenged lawmakers to test the policy in states like Vermont and Massachusetts, represented by cap supporters. Dimon is confident such an experiment would quickly reveal the downsides: less consumer spending and a rise in high-cost, unregulated lending. The banking industry is united against the cap. Leaders argue that lending isn't one-size-fits-all. Interest rates are how they price risk. Forcing a flat 10% rate, they say, would mean cutting off millions of higher-risk borrowers, creating a credit desert. To make up for lost revenue, banks warn they'd introduce new fees, bring back high annual charges, and scrap popular rewards programs. Even basic services could become more expensive. Citigroup's CEO doubts Congress will pass such a drastic measure, but banks are preparing to fight in court if needed, calling the cap government overreach. If a 10% cap became law, the effects would be immediate. People with good credit would save money, but millions with lower scores could lose access to credit as banks tighten standards. Without credit cards, families might turn to payday loans or pawn shops, options with even higher costs. Small businesses would suffer as consumer spending drops, potentially leading to layoffs and closures. The economy could slow or even tip into recession. For banks, the cap would wipe out a major profit center. They'd cut risky borrowers, shrink credit limits, and eliminate perks. The result, a two-tiered system where only the wealthy have access to affordable credit. Wall Street's reaction to Trump's proposal was swift. Bank stocks tumbled, fearing lost profits. But as days passed, markets rebounded, signaling most investors doubt the cap will become law. Analysts see the proposal as political theater before an election, not a real legislative threat. With a divided Congress and powerful banking lobby, passage is unlikely. Still, the pressure could prompt credit card companies to offer new, no-frills cards with lower rates or make other small concessions to avoid regulation. These moves would be designed to show they're listening to consumer concerns, hoping to stave off a more damaging government-imposed cap. A 10% cap would create clear winners and losers. Consumers with good credit and high interest debt would benefit most, saving money and paying off balances faster. But millions with lower credit scores, young adults, those with past financial trouble, or lower incomes, would likely lose access to credit. Banks say the cap wouldn't cover the risk of lending to them, so their cards would be cut or denied. The financial industry would lose billions in profits, leading to layoffs and stock declines. Small businesses would also suffer as consumer spending drops, threatening local jobs and economies. The future of credit card interest rates is uncertain. Trump's proposal has sparked debate, but a nationwide 10% cap is unlikely given political and industry opposition. Still, the spotlight on high-interest debt could push companies to offer lower-rate cards or more transparency. Lawmakers might pursue more moderate reforms like higher caps or clearer disclosures. For now, the best defense is personal payoff balances in full, seek lower-rate offers, and stay vigilant. The terms can change, but smart financial habits remain your strongest tool.